Good morning, everyone, and a warm welcome to our earnings conference call for the Qtr4, ended 31st March 2018. I am joined in the call by my colleague, Mrs. Akhila Balchandar, Chief Financial Officer of our company. For the first time, we have the management team of Holiday Club Resorts, CEO Mr. Iro Rossi and CFO Ms. Nina Norberg are also on the call. And I would like to begin by sharing with you the performance of Mahindra Holidays, and I will touch upon the performance of Holiday Club Resorts as well. I'm pleased to share that Mahindra Holidays added 6,321 new members this quarter. This is an increase of about 2.3% YOY and on QOQ or sequential growth of about 50.7%. Our resort occupancies were at a healthy 85%. Our resort revenues grew by 9.9%. Coupled with improvement in operational metrics and cost management actions, we have seen a growth of 21% in profit after tax to rupees 38.5 crores as compared to rupees 31.8 crores last year. We added 3 new resorts this quarter, Dwarka in Gujarat, one more resort in Dubai, and Mahabaleshwar. These were the new additions to our bouquet of resorts and the net addition of 110 rooms this quarter. For the full year 2017-18, our profit after tax is at 134.3 crores, which is up by 2.8% year on year, and our cumulative member base stands at 235,792 members. This is up by 8.1% year on year. For the year, we also added 320 rooms. This includes the 110 rooms that I mentioned in the Q4, taking our total inventory count to 3,472, making us the largest leisure hospitality player in India. I would like to also mention that in this full year, we added 6 resorts, 3 I mentioned already, 3 more were added before. Naldehra came in. This is a project that was started 3 years ago. This is our greenfield resort, Naldehra near Shimla, that got commissioned this year, Singapore as well as Kochi. Our total resort count now stands at 55. Our sustained focus on getting quality members with higher down payment and lower tenure EMIs and sustained focus on getting our receivables back in time has helped increase our cash balance to 469 crores. This is up by 205 crores for the same as on 31st March 2017. We have also noticed that as a result of our consistent cost management actions that have been going on for years now, we have seen an improvement in the PBT margin from 18.4% to 18.9% this year. Now let me move on to the Holiday Club Resorts. Very happy to share that our consolidated profit after tax, together with the other comprehensive income, is at 192.7 crores, which is a big jump from rupees 116.8 crores. And these are the consolidated figures I am giving you right now. However, if we were to look at Holiday Club Resorts turnover, this would be right now what we have declared, and we hold 95.16% stake in this company. It's a material subsidiary. The turnover recorded was 165.5 million euros, 249.6 crores, as against euro 161.5 million, a turnover of rupees 1185.7 crores for the same period last year. As you know, this acquisition has given us access to Finland, Sweden, and Spain. We have 33 scenic resorts which are open to our members, and there are, of course, 50,000 members which are there in the Holiday Club Resorts. They have also got added to our family. This makes Mahindra Holidays the largest vacation ownership company in the world outside of the United States. On the business expansion front, coming back to Mahindra Holidays, our ongoing investment of 500 crores will add further 500 units to our total inventory at the close of FY19. On Mahindra Holidays, I would like to once again mention that we have emphasized on providing the best holiday experiences to our members. Our in-resort activities now boast an array of experiential activities including cultural shows, traditional arts and crafts workshops, coffee tea plantation tours, beach pool activities, summer camps for children, local culinary experiences, and a lot more. We have also partnered with local experience providers at several destinations to further increase the scope of destination activities for our members. These include heritage tours, cycle tours, adventure sports, etc. At this point of time, we are also focused on providing the best-in-class in-city experiences to keep members engaged while not on a holiday, leisure experiences. FY 2017-18, we expanded our Dreamscapes project to about 30 cities. This is powered by Zozoday, the company in which we invested. We took a minority stake in this company. This is a startup based out of Bangalore. We have now 2,000 in-city experiences listed to our members across travel, adventure, gourmet food, health and wellness, and art and learning categories. We have also introduced curated vacations for members looking for unique vacations. These are not run-of-the-mill vacations exclusively chosen by the holiday experts of Mahindra Holidays. I must also add vacation here, which actually provides our prospects the opportunity to experience our product actually in a day. And furthermore, in an attempt to reach out to members in their cities of residence, we have conducted several heart-to-heart events which received a positive response from members. Our latest product, Bliss, which is a 10-year Club Mahindra membership targeted for people above 50 years or more, has now been rolled in 14 cities across India. Before I progress further on Mahindra Holidays, I would like to also add in Holiday Club, we have generated 12 million euros of operating cash this year, and the dividend of 1.8 million euros of HCRO has been declared by the board of directors. So this is something that I missed in the earlier one. Now I will continue from Mahindra Holidays. I would like to take this opportunity to also highlight that we are spending significant amount of money on digital presence. We have launched our mobile app to enhance our member engagement and provide customized services. In fact, we have crossed 100,000 unique downloads, and about 84% of our bookings and transactions come from online platforms, which is our website and our app, out of which 35% are through the mobile app. We are adding features related to EMI payment and annual fee payment. All these features are active and members can make these payments happily through the app as well as do the bookings and get to know their holiday updates, including their status of the upcoming holiday. Our emphasis on social media engagement during the year has resulted in much better brand recall, much better connect with members and prospects, and a much improved digital presence. We are certain that going forward, FY18 and 19 will be a fruitful year as we look at positively. For the looking ahead, we feel that the rise in domestic tourism that we are seeing with all-round much better connectivity and the increase in low-cost airlines, we believe that the future, our outlook on future is positive. We believe that we are in a position to continue to add new unexplored destination and enhancing member delight in time to come. With this, I now open the call for questions. I think the process that we have followed is that there are questions that come one after another, and we will be answering all of them till about 12 noon. So we have another 45 minutes for the questions that you may have.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Aditya Bagul from Axis Capital. Please go ahead.
Hi, sir. Good morning, and thank you for taking my question. Sir, can you share your thoughts on the growth rate on our key revenue line items, VO income, resort, and ASF over the next 2 years, along with probably some idea on what kind of membership growth we would be targeting? And in the same breath, sir, I'd like to know what is the reason for the decline in the VO income both during the quarter and FY18. Also, the ASF has not grown meaningfully this year. So if you could just give us some idea there.
So I would request Akhila to handle some of your questions related to the financials, and I will come in into as how we look ahead into the future.
Yeah, sure, sir.
Thanks, Aditya. So Aditya, on the two questions that you have on the income from sale of VO and income from ASF, let me take the ASF piece first. So if you remember, we've been saying that over the year, last year we migrated to INDAS during 16-17. And over the period, we also tightened our provisioning norms as per the ECL methodology. And during the year, at every quarter, we had a fairly flat growth on the ASF, though we were pretty happy internally because we know what the numbers were growing. A fair amount of the provisioning last year, because the first year under INDAS happened in the Qtr4. And this year, we have migrated on the annual over the period. So to some extent, the quarters were fairly muted, and if you therefore see the Qtr4 is pretty much looking very good, but on the annual level, we are at a 3.1% growth, which is in line with our member addition and also for the factor for the annual ASF increases. Some of this is purely an accounting requirement where the norms globally also are getting tightened on provisioning, and it's not that there is a provisioning, this is not an actual incurred loss, this is also the expectation of loss which we have worked based on some models and internal methodology. So if there is a provisioning, it does not necessarily mean that we expect it to be a loss. It is just that the accounting guidelines ask us to be more tight, and therefore we have gone for the expected loss methodology.
Sure.
Second, the same was good for also my VO income. So there was a transition last year, which over the year we also finally did a final review during the audit. And if you remember, we had done a one-time provision of 21 crores in the expense line. Whereas in the current year, we have now made it a part of our accounting policies, and it is very much disclosed in our revenue recognition policy. So while the units have grown, our revenue recognition has become far more prudent or tighter in line with the requirements of the accounting standard, and therefore on a growth basis we see some mismatches. But otherwise, if you factor in, I think it's in line with the unit growth. I hope this answers your question.
Ma'am, if I may just have a follow-up on that.
Sure.
So there are 21 crores of additional provisioning sitting on the income from VO. So if we add 544 plus 21, that still gives us 565 crores for the full year, which is still 5% lower than our previous year's number. Now, if we have 8% growth in our membership, plus we've had at least 5 or 6%.
I would request you to look at it at the annual level. So if you add that 21 to the annual number,
which is what I'm doing, ma'am.
So there is a growth of 3%.
Okay, maybe, ma'am, I'll take this offline.
Sure.
Ma'am, and my second question also relates to a data point. We have about 1430 crores of receivables. If you can just, both long-term and in the current assets, if you can just let me know what is the proportion of those receivables which are overdue 6 months?
So if you see the disclosure itself, it is fairly clear. What is current is exactly what is something which is collectible immediately and within the next 6 months. And the non-current is the portion which is due only after a period of 6 months.
Okay, fair enough, ma'am. Fair enough. Thank you so much. Sir, if you could just help me with understanding what our long-term thought process is.
Okay. I just wanted to bring one more perspective that while these issues of INDAS, which Akhila was talking about, these are now already built into our this year's performance. So you can obviously understand what I am trying to say, that, this transition impact is only limited to 17-18. Right? So the impact whether on VO income or ASF income. ASF was because we took a call to do a tighter provisioning than what we have been doing. And VO is a function of the INDAS, as she explained clearly. Now, as far as the business goes, you've already seen that we are, in terms of member additions, the Jan-Feb-March quarter is typically a good quarter, and we have been able to sustain the momentum that we had last year. And sequentially, if you look at it, we have 50% up. Now, looking ahead, what we are doing is to strengthen our proposition even more than what we have already. We are in our resorts, as you notice, we have created a lot of activities which I talked about, and we are using on the sales pitch this kind of the fact that the families have a good time, the families will be able to bond. The core pitch is being further strengthened. As far as the digital and referral way of picking up leads is concerned, the referral program is also being accelerated, and our digital presence, as I was mentioning, and one of the reasons why we are present in a big way in digital is that we get significant percentage of our leads through the digital route. So our focus on digital referrals and alliances with the brands, which give us high quality data points for us to reach out to our target prospects, along with the fact that we have now even the ability to reach out to people through an extremely targeted way, including the various channels that are available through the digital route, which I mentioned, through the referrals, and because we are using analytics, which I had mentioned last time around. So analytics coupled with the fact that we are using digital referrals and alliances are giving us reasonably high quality data in being able to reach out to the prospects in a meaningful way. We are finding our overall conversions are improving. Our costs of acquisitions are in control. And one thing that we are trying to do, which has not probably allowed us to increase our member additions this year, is our focus on higher down payment and lower tenure EMIs. Because we are going after higher quality members, therefore the higher down payment and lower tenure EMI is something that is now becoming basic for us when we reach out to a prospect, which we believe is one of the biggest reasons for our cash balance to move up from 264 crores to 469 crores, an increase of about 205 crores in just 1 year. If you go back one more year, it was 84 crores, it moved to 264 crores. So what we are doing is, we are trying to reach out to members where they have the capacity to pay. They pay higher down payment. They immediately start enjoying the holiday. They have a much better experience. Therefore, their payments on both EMI and ASF will be regular, which we believe will lead us to lower provisioning in time to come. And these are the measures that we are taking, and therefore we transitioned from a stage where we would be happy to sell our, at a down payment of 10 or 15%. But that is something that we are significantly reducing, and we are encouraging people to go to 30% down payment, 50% down payment, full year payments. And this is what is helping them to experience the product early and therefore stay with the product, which will help us to get us much better collections, which will help us to continue our journey on the building the cash balance that we have built up. So this is the strategy that we will follow to tackle this whole issue of growth, but higher quality members growth, parallelly improving our cash balance. This is what, in a nutshell, is our strategy that we played out in 17-18, and we continue to do that. Of course, we will become much sharper in getting much higher quality data as we move ahead.
Sure, sir. So would this takeaway be accurate that post all these provisioning and Ind-AS impact, going forward, our revenue growth would be ahead of our membership additions? Would that be a fair thing?
So normally, I have made this point earlier with you that I think at a thumb rule level, if we are growing in member additions at a single digit level, definitely our PBT would grow in the early double-digit levels, partly because of the annuity incomes, and that is how it should play out, because as you notice in this year, ASF income got impacted, even though in Q4 you are seeing early signs of recovery, but definitely for the full year, the ASF income got impacted because of the tighter provisioning norms. Now that they are built into the base, we believe that the annuity income growths, the resort income growths, and the interest income growth, is of course the EMI related things, they are obviously moving in line with their past patterns, but the fact that the member addition growth gives a kicker to because there is a accumulation effect that happens, and that is what will lead into the journey forward. And I want to also give you one good news. If you really look at it, our resort additions earlier were lagging behind. If you notice that despite our lease, income, lease rentals growing dramatically much higher than what they were last year, we have been able to maintain our profits for the full year. And the lease rentals are something that they are as a result of the fact that we added 5 new resorts, and what it does to us is that we create the inventory for people to enjoy holidays, which means better stickiness with us, which means lower provisioning going forward, which means better resort revenues. So it is a virtuous cycle. What we have to do is to do the right things. The right things to do in our business are to continuously add experiences and resorts, continuously target higher quality members who have the capacity to spend, and ensure that we are moving all metrics simultaneously, not just the P&L, but the P&L, the balance sheet, as well as the cash position needs to be moving together, which is what this business is all about.
Great, sir. Thank you for that elaborate explanation, and best of luck for the quarters to come.
Thank you, Aditya.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit a question to 2 per participant. Thank you. The next question is on the line of Nihal Jam from Edelweiss. Please go ahead.
Hi, sir. Good morning and congratulations on this good set of numbers. So just confirming the point that Akhila ma'am made, was the 21 crore number that was mentioned taken away from VO income was all in this Q4 quarter?
In last year, yes, we had done a one-time provision in last year, which was taken in the Q4 of last year.
And what was the number in Q4 FY18?
So Aditya, so Nihal, basically now we have made it part of the revenue recognition policy, and therefore it is adjusted in my revenue itself.
So that would explain this divergence specifically for Q4, where a member growth has been flat and the VO income has fallen by 11%.
That's correct.
Okay, sure, ma'am. Just second point on some data points. What was the sales and marketing spend for this quarter and the comparative figure last quarter?
So current quarter, we have spent 74 crores vis-a-vis 63 crores last year for the same quarter.
Sure. So if I had to look at our other expense, where has most of our saving happened, which has led to this margin expansion for us? If because I see that the sales and marketing expenses are obviously seen a good growth on a YOY basis.
So Nihal, basically the margin improvement has happened in the YTD figures also. In terms of sales and marketing spend, traditionally also we do, our best quarter is always Q4, and we ramp up all our sales marketing spend in order to gear up for that. So to some extent, it's also about timing of our expenses when we do a brand promo, when we do a marketing spend, how we want to time out our initiatives and also take advantage of the same in the April, May of the next year. So this is an ongoing activity and initiative, but obviously Q4 is our best quarter and we keep. But on an overall level, if you see for the year, our sales and marketing spends have been very well controlled, and we have actually reduced the cost of acquisition in this year compared to last year, which is what we've been sharing over the quarters. Now coming to your second point on how have we managed to improve the operating margins. So there are this is not just related to sales and marketing. This is a complete drive on cost optimization across resorts, across overall spends, our IT spends, optimizing the breadth and scale of the group's initiatives sometimes. And this really has been something we've been now doing not just this year, but over the last 7-8 quarters, which is yielding results to us. And that is where I think we really got some of our kickers.
Okay, sure, ma'am. Just the fact that we have the HCR management also here, and we have seen that there has been a sharp improvement in profitability in HCR for this year. So just wanted to comment on what has led to that, and in the past, what is the kind of peak profitability that this business has seen, and how do you plan to take it ahead?
So, Nihal, you may want to break your questions into 1, 2, 3 because, our Finnish friends may not be able to answer 3 questions loaded in one. So my suggestion is just break the question 1 and question 2 and question 3. Definitely, Hiro and Nina are here to answer your questions.
Absolutely. So my first question on HCR is that what has led to the improvement in profitability for this year, where we've seen a more than a 2x jump in profitability?
Yeah, I would request Mr. Hiro Rossi or Nina to take this question.
Thank you, Kavinder. It indeed was very, very nice improvement altogether. I'm glad to say that it came from several, or I would say from all the fronts. We did some cost optimizing. We renegotiated all the contracts, rental contracts for the couple of hotel units, headquarters rental agreement, all the service contracts. So it was partly cost based, but from the business units point of view, I think it's spread over. We are looking at the hotel business separately, and then time share and fractional business separately, and then from our point of view, the international business, meaning Sweden and Spain, and the improvement was, I'm glad to say, spread all over those 3 or 4 units. So it's both cost-based and business units. Better efficiencies in all the businesses.
Nihal, you have any other question other than this one?
Yes, just 2 more on HCR. Secondly, in the past, what is the kind of peak profitability that this business has seen? Because I understand over the last 3-4 years, the performance has taken a downturn.
So, Hiro, you may want to go back a little bit in the past to share with them what was the peak profitability or the profitability that was probably the best profitability that you have seen in the past years.
I think when we go back a few years, we took over the hotel business, bought the hotel units back in 2011, and after that acquisition, it has been constantly improving. And in that regard, in the hotel business, it has been better every year. So this, in a way, is the peak.
Okay, so this is the peak, and part of the reason might be that you also acquired the Spanish assets as well as the Sweden assets over a period of time, so you may not get a like-to-like comparison.
Exactly. You're right, Kevin.
Yeah.
Sure, that answers. I'll get back in the queue for further questions. Thank you.
Thank you.
Thank you. Is the next question from the line of Chirag Satalwat from HDFC Mutual Fund. Please go ahead.
Yeah, hi. Can you give us the profitability, the revenue, the EBITDA and profit of HCR separately, please?
Sorry, Chirag, can you repeat the question?
If you could provide us with the revenue, EBITDA and profits of HCR separately, of holiday resorts.
Sure. What we will do is, I think once the final audits are closed, these audits will be, the annual accounts will be out, but we'll take some more time to release those because we have not currently put it in the public domain.
Yeah, is it possible just to provide the profit?
So if you see, this time we've published the segment results, and they have done a profit of 67 crores as a group, vis-a-vis 23 crores last year.
I was a little confused about this exchange difference. If you could just explain that to us, because when we look at your results, one is on a consolidated basis, you have 133 crores of profit after tax, and then after that you have a foreign exchange item of 60 crores. So I was a little confused what the foreign exchange item relates to, and if you could just explain the nature of that.
Sure. So let me just run through the segment results that will help me clarify this. So we have separately shared the MHRIL results and the HCRO results. And post that, what we do have, the borrowings that we have taken for the acquisition of the Finnish entity lies in one of our holding companies abroad. These borrowings are in euro, and the assets, if you understand, are also in euro, which is the Finnish entity itself. But when we do a translation, because the euro has appreciated, one leg of my translation goes into the P&L, and the other leg, these are the accounting guidelines and norms under IFRS, which we are now following, goes into the leg of the translation on investment, goes into the reserves directly. So I have two legs of the translation which really do not knock off against each other in the P&L or in the reserves, but in different parts of my overall annual financial statement. The loss portion is currently sitting. The 41.40 is what we have incurred as a translation difference, which comes into my P&L. And there is a 61.94 crores appreciation which we see on the underlying asset, which gets directly transferred to the reserves. That is why we have tried to give a little elaborate explanation to it, even in the regulations that we have filed. The way I would look at it as the management, therefore, is the segment results before translation difference, which was 212 crores last year, vis-a-vis 258 crores this year, which is a 21% jump.
So just so that I understand, there was a 41 crore loss to the P&L and a 60 odd crore gain to the balance sheet.
That's correct.
And the profit of HCR was 67 crores this year versus 23 crores last year.
That's correct.
And in the opinion of management, is this 67 crores number broadly sustainable?
The question to you is that the profits of 67 crores that we have declared in our segment results, are they sustainable? How do you see them ahead? Normally, we do not give guidance, but I think the question is more directional question, that how do you see the operations, and therefore, do you see that this is like a one-off, or this is likely to sort of continue depending on the situation that you see over there in the overall macroeconomic factors that you see in the business environment there? Over to you, Hiro.
Thank you. Sustainable, definitely. It's the economy is looking good. The growth is not the same than in India, but the consumer confidence is high all over Europe, particularly in Finland. There will be growth in the economy in Finland, Sweden, and Spain, and we will continue to grow. The outlook is very positive, and of course we are constantly looking at acquisition opportunities in particularly in Spain, and maybe construction opportunities in Sweden. In Finland, we have plenty of land to develop around our existing resorts. So I'm very positive.
And the last question is if you could give a breakup of HCR revenues between hotel revenues and timeshare.
Akhila, do we have these figures of hotel and timeshare revenues? Are they?
I can roughly say.
No, Hiro,
related.
I think, Hiro, we need to just check, because if they are not yet out in the public domain, then I think Akhila will have to answer this.
Okay.
Chira, what we can do is maybe in a couple of days, we can share this, because then we would like to share it with all the investors jointly. We currently would not like to make it, a part by part disclosure.
Sure. So I think what would be helpful, ma'am, if HCR, if you could give us a breakup between hotel and non-hotel in terms of revenues and hotel and non-hotel in terms of profitability.
Sure. We'll do that.
Great. Thank you very much.
Thank you. The next question is from the line of Arjun Khanna from Kotak Asset Management. Please go ahead.
Thank you for taking my questions. My questions are in the same direction. So just trying to understand the numbers year on year for HCR. In FY17, we had a segmental EBIT of 23.07 crores. And assuming all debt was only for HCR, since we are a net cash on the standalone business, we had an interest of roughly 19.71. So our net PBT, assuming for that business unit, comes to 3.36 crores. And for FY18, we have, assuming all debt for HCR, the interest and readjustment comes to 63.7, and our EBIT is 67.09, as you had mentioned. So that comes to 3.39. Is that a fair understanding of reading the numbers?
Akhila, please answer.
Arjun, can you repeat your question?
So our EBIT, as you have said in the segmental numbers, for FY18 for HCR is 67.09 and FY17 was 23.07.
Correct.
Our finance costs for FY17 was 19.71 and for FY18 was 63.7, including the readjustment of our Forex.
That's correct.
So the net impact is that on a PBT level, assuming we collapse this structure, the PBT is flat year on year. That's a fair understanding, right? Because all the debt would be only for HCR?
That's correct.
Okay. My second question is, given that the euro or the rupee has depreciated further against the euro, we are close to 18 now, and last year we would have ended at, on an average, roughly 77.5. So we are looking at this year also a potential Forex charge, assuming our debt level is similar at 713 odd crores. So next year also it's not likely we would see any substantial PAT. Is that a fair reading?
So Arjun, what I would like to reiterate and explain again is this. Mahindra Holidays as a group has taken borrowings in euro.
Right.
For investment in the Finnish entity, right? So I have got loans which are denominated in euro, and I have got an investment denominated in euro.
Right.
Which is, as you've seen, has been performing fairly well this year. The euro obviously has appreciated, giving rise to translation difference. Now the translation has to work both on the liability and the asset. Now the way the accounting guidelines are structured, one leg goes into the P&L and the other leg moves into the reserves. Now if, for example, the euro changes trend, right, I could have a gain next year point in time in the P&L and an adjustment in the reserves next year. Fair. So from an entity perspective at the consolidated level, I really do not have a real Forex loss happening because my underlying asset and underlying borrowing are both in euro.
Sure. Actually, I just wanted
translation, I will keep having these adjustments in my consolidated financial statements.
Fair. I just wanted to understand on the asset side. Now, on the asset side, have our inventories moved up because we have created more hotel units or fractional ownership, or have they moved up because of the translation impact?
So it's a mixture of both. As we said, the
is it possible to break that up?
Entity has generated 12 million of cash on their own, like we have generated cash in the Indian operations. These have been used continuously for their own business purposes as well as payout of dividend. Now, as far as HCR goes, the business model is such that they will keep on investing, building new resorts, and therefore inventory will keep moving up and down. That's the kind of raw material for their business. inventory going up is not necessarily a concern because without the inventory there will not be any sale.
Perfect.
So this growth in the inventory that you're seeing is a mixture of both the translation as well as increase in the overall inventory position.
Ma'am, because we don't have much clarity on HCR, would it be possible to publish their numbers in terms of the format which we have for Mahindra Holidays, I mean for distribution to the wider public as and when possible, including the inventory numbers, in addition to those details asked earlier of hotel and timeshare?
Sure, we can do that.
Sure. Just on the domestic piece, in terms of the number of keys addition, Mr. Talvinder indicated you're looking at 500 keys in FY19. Did I hear that correctly?
That's right. By FY19.
So in that...
so let me answer this. Let me explain so that probably the question will get answered. So what we are saying is that we have ongoing projects in 3 locations, and they will add up to about 500 units, and that's the 500 crore capex now because the Naldehra came through, which is about 100 crores odd came through out of the 600 that we had announced. As we speak in this financial year, we are definitely expecting 2 of the projects to finish their phase 1, which will add a certain number of units, and the balance will come in 19-20. That's why I said FY19 close, we should see this 500 units coming in and the capital expenditure program completing of the 500 crores. That's what I meant.
Sure. Thank you so much.
Thank you. The next question is from the line of Bharat Subramaniam from Sundaram Mutual Fund. Please go ahead.
Yeah, morning sir. Thanks for your time. Just wanted to check in terms of the domestic piece, we've added member additions close to 6,000 plus. So could you break it between how many would have come in through the new product that we had launched for the senior citizens, if we can?
So we haven't done that because as far as we are concerned, it is the same, vacation ownership product. It just got a different tenure. So this is really something that we haven't yet put it out in the public domain, but I can only tell you that it's gaining momentum, and that is why we are going ahead and launching it in the other cities. It is to tap an adjacent segment. It's a lower tenure, points-based flexible product, and we believe that that's another, a product that we are banking on to grow. And maybe at some point of time, once we have gained sufficient scale, we may start disclosing the numbers. But really speaking, this is like product-wise breakup. It's probably may not be even required because at the end of the day, it's the same construct of a vacation ownership product.
Or put it the other way, in terms of incremental member addition, do we see a skew towards this particular product where the tenure is lower?
No, I don't think that people would en masse move to this product because the key thing really here is, this is a mistaken notion that people want lower tenure products. Because the real value of our proposition is the long-term, ability to holiday long-term, which means over 25 years. And that's where the benefits accrue to the members as well as to the organization, because there is a lifetime value that we are internally calculating, and we actually keep an eye on what is the member's lifetime value and couple it with the acquisition cost that we incur upfront. It makes sense for members to stay longer with us to enjoy their family vacations over a longer period of time, because the families undergo, from a pure marketing point of view, if I were to say that, people go through their different life stages, the holidaying needs change, they upgrade, and we also make upgrade revenues, the F&B revenues change when they travel with friends and relatives. So there is this whole concept of member life cycle value which gets enhanced over a longer period of time. The idea of this 10-year product was to actually tap the adjacent segment that, seniors are now beginning to travel alone. And if they have not been with us, and if they have not taken the 25-year membership, and if they are at 50, 55 years of age, our selling proposition was becoming weaker to them, because at 55, someone is probably not thinking of 25-year product. though life expectancies are rising, but we still believe that that actually filled that gap. So we don't believe that becoming the skew of member additions moving towards that product, because our core target audience still remains 35 plus family, and this will be an adjacent product. It is just that we are filling a gap which we should fill, because as the number one player in this category, we should look at all segments, holistically. So that's the objective of this product.
Sure. And my other question is in terms of the member to room inventory metrics that we typically track. So despite a 500 key addition, would you think the metric would still remain a bit tight? Given the last 2-year trends of member additions we've seen, adding 500 keys would just meet whatever we would be adding in terms of member count for FY19. So looking into a year down the line beyond FY19, how are we planning our room inventory?
So I think the way we handle our room inventory, if you notice, even in this year, only 1/3 of our room inventory came through our own project, which is Naldhera, and the 2/3 came through the leasing route. But if you look at an overall level, we have about 65% own inventory and about 35% is leased. So the idea here is that we use this mixed strategy to accelerate our resort additions, while obviously accelerating member additions. And obviously, in some of the areas, you don't get permissions to actually, create a new resort because of the environmental constraints. So we do sometimes, for example, the property that we took in Mahabaleshwar is our second property. It's on lease. The idea here is that you really can't easily construct something in Mahabaleshwar, so there is a demand, so you actually go out and lease. So we have this asset-light strategy bundled into our overall model. And when I say 500 units, it does not mean that we will add only 500. As you can see, this year itself we added 320. And if I split 500 over 2 years, it would mean only 250 units. So we definitely will need to lease over and above the average rate of 250 units that could come potentially through our own projects. And as we go ahead, we will keep announcing the newer projects, because the land acquisition process is constantly on. We have land banks. So our rate of inventory addition has to be in line or ahead of member additions. That is the strategy that we are pursuing. So 500 does not mean that we will add only 500. We will definitely add more than 500 units, because the leasing route is always open to us, and that we have pursued in the past, as you have seen.
Fine, sir. Fine, sir. That's it from my end.
Thank you. The next question is from the line of Chirag Setalvat from HDFC Mutual Fund. Please go ahead.
My question has been answered. Thank you.
Thank you. The next question is from the line of Manish Podar from Renaissance Investments. Please go ahead.
Hi, sir. Just wanted to get a sense that I believe you have launched another type of membership, which is for a 3-year tenure. Is that right? And which is offering the same benefits, let's say, of a 25-year tenure, just the payments and the terms are a little different. But what is the rationale, and do we intend to scale it up, or what is the rationale for adjustment on it?
So again, from a consumer standpoint, as we speak, we are test marketing this product called Go Zest. This is a product for millennials. You know that we tap members in the age bracket of 35 plus, who are family with children. We believe that this segment of 25 to 32, because when we generate leads, particularly through the digital route, we do get leads which are in this age bracket. So we have thought of creating a starter product. It's a truly a starter product. It is not the main course, if I were to use the food terminology. So the idea here is that you sample what we have to offer. It's a 3-year product. It is still being test marketed. Therefore, we have not gone on record. But since you asked me, I had to sort of tell you that this is more an experiment going on to see, can we create a funnel? See, the idea is that when you like the first 3 years of experience, you may want to join the 25-year, because your life stage will move. If you join this at around 28, 29, young, newly married, or even a single, over 2-3 years, you may have experienced this product, and as you reach that particular age and you have children or even otherwise, you may want to sign up for 25. It is a very standard practice worldwide to look at starter products. We never had a starter product. So we believe that this could tomorrow funnel growth for our core member additions. Therefore, this experiment is going on. This is not really even launched yet. There is some minor test marketing happening. And so it's not that we have sold any units and they are not accounted definitely in the financial year 17-18. As we speak, the test marketing is going on internally. So we are wanting to test the proposition and see whether it works or not.
Yeah, because I was just confused. Let's say if the salesperson from your end has to sell one of the two products, he would let's say, because of incentives or some other structure, if he starts selling the 3-year product and you're making results with a 25-year view in the place.
So we are very, very careful. We are very careful. We definitely ensure that the incentive structures are aligned. And second thing is the core Club Mahindra product, people who are selling, they will never sell this product. We have a separate sales force which sells Bliss, which is the 10-year product. And if this product takes off, we will think about how do we want to, create the sales force delineation, because we really do not want any cannibalization happening from our core product. So we are very mindful of that. Really appreciate your question.
And just 2 more small ones, if I can. Has there been any like-to-like increase in the membership cost, let's say, this year? Or are we building any number for this year?
In the quarter 4, Akhila, you may want to talk about.
Yeah, so Manish, like I explained earlier, if you see on an annual basis, our our sales cost of acquisition and sales and marketing expenses have been under control, and we have in fact reduced our overall cost of acquisition. In the quarter 4, we have gone and done a lot more branding and digital acquisition initiatives, and to some extent there has been an increase in the sales and marketing expense.
Okay, and just one small thing, if I heard it right, you all have not given any room addition, let's say, for FY20. We are just in the planning stage of now.
See, we normally do not talk of room addition plans, but we have obviously greenfield additions that we are doing. That 500 units which I've talked about, which will come in 18, 19 and 19, 20. That is because these are the projects which are going on. So therefore, it's our normal business to create resorts, and we do share what's happening so that you have an idea of the capital expenditure, the number of units that will come. But how much units we will lease, how much units more we will add, we constantly calibrate, because you would understand that we don't want to run too much ahead and we don't want to be lagging behind, and therefore we do not give out in the public domain as to what is our total room addition plan for this year or the next year. But you have seen our pattern. I mean, you have seen how much we have been adding. If you go back 3 years, we were at about 2,400 odd units, and now we are at about 3,472. So on an average, if you were to look at it in the last 3 years, we added about 1,000 odd units, but capital expenditure of this kind wasn't there, so there is some acceleration that we are definitely seeing looking ahead.
So effectively that 9% odd run rate growth run rate which you're looking at?
No, we don't want to say this, because we don't want to commit to just 9%, because we are seeing opportunities beyond 9%, definitely. That's why we are investing 500 crores. And as we speak, we have land banks, and we are planning newer projects, which we are obviously not right now putting it out, because there is some work happening over there. So we are definitely not wedded to this 9% number. We would definitely like to accelerate our inventory additions.
Great, and all the best. Thanks.
Yeah.
Thank you. The next question is on the line of Bhavesh Jain from Envision Capital. Please go ahead.
Sir, if I see, you said a cost of customer acquisition have come down, but I see in last 3 years, our sales mix by source of lead from digital and referral sales have come down by 5 percentage points. So that is a conscious strategy, or what it is?
So, really speaking, we obviously go all out in the market to drive digital and referral sales, but I must tell you at this point of time that digital sales are not cheap. They are expensive. because as you know that digital targeting happens on Facebook, Google, and Yahoo, etc., and these people continuously raise the rates for advertising on their websites. So it is not something that the digital brings down the costs. Digital hasn't yet brought down our costs. On the other hand, referral does bring down our costs. So our aim is to drive these, but we cannot be off digital because there are a lot of people today who search and find out about products on digital. Therefore, digital presence is a must. So as far as our drive is concerned, we continue to drive digital referrals, but the other sources are now, we are getting into alliances, as I was telling you, about with various brands. And the whole idea is that you are able to tap then the people who are likely to buy, therefore improve hopefully your conversions and bring down your cost of acquisition. So it's a constant mix which keeps changing, but we have been fairly good in maintaining our cost of acquisition if you were to take a slightly longer term trend. In fact, this year we are lower than the last year. So the movement which you talked about specifically about digital referral going down by 5 percentage points, if you ask me, directionally that is not a very big change. We are in the order of about 50%. Sometimes we do 53, in some months we do 48, but we are hovering at around 50%, which is a good mix as of now. We are definitely would like to scale up this, but this requires obviously more investments in digital because referrals we are anyway going all out. And we are being a little bit careful in putting money in digital because as I mentioned to you that while we generate leads digitally, but conversion happens offline, therefore the cost tends to be slightly higher. But of course the conversions are better digital. So it's a kind of fine balance that we are trying to arrive at. So therefore you will see this number for some time, I think at about 48-50%.
Thank you. Mr. Jain, may we request you to join the question queue for any follow-ups as we have several participants waiting for their turn. Also, participants are requested to limit their question to one per participant. If time permits, they may join back to the question queue. Thank you. We have the next question from the line of Sarat Mukherjee from Stewart & Mackintosh. Please go ahead.
Good morning, sir. My question regarding the provision has been already answered. My second question is more into the business aspect. The sector generally earns around 50% of its revenue from the corporate clients, and we have also recently seen that the corporate tariff has gone up in the sector. Now, sir, our model is more focused on the membership, mainly on the retail level. So I wanted to know what is the exposure to the corporate clients, if any, and is there any planning to exploit the avenue to corporate membership?
That's a very good question. Our business is retail, as you rightly put it, and we believe that we are a truly, a B2C business. Actually, if you were to look at it, we are B2C2B. The business approach the customer, and when the customer joins us, then the customer is dealing with the business for a lifetime of 25 years or for a longer period of 25 years. So ours is a very unique B2C2B model. And when you look at the corporate product, B2B, we do have corporate clients of the past. This year we haven't got much success in the corporate business, and that is because of the organizational restructuring that we have done. Definitely we would like to expand this business, and part of the reasons that this business is not expanded is, as I mentioned, because of some organizational restructuring that we did inside. But I fully agree with you that the corporate business is a business that we should go after. However, I must say that our business will fundamentally remain retail. Corporate business will certainly be a small portion of our business. We do not see corporate business becoming dominant in the years to come.
Thank you. Ladies and gentlemen, due to time constraints, we'll take our last question. That is from the line of Rohit Seksaria from Sundaram Mutual Fund. Please go ahead.
Yeah, hi sir. I had one question on this provisioning for ECL in vacation ownership income. Last year, our provisioning was around 21 crore. This year, apparently, the number seems to be higher. So do we expect a similar kind of numbers going ahead every year?
So Rohit, let me re-explain the whole concept. Under last year, that is the financial year 16-17, we migrated to INDAS. And over the years, there was a different policy, basically incurred loss, as and when we believe that a member is not good, we used to do the provisioning and activation of those things. What INDAS requires us to do basically is to estimate an expectation of loss and build it into the provisioning requirement. We did this assessment last year in the Q4, and we did a one-time provisioning of 21 crores. This year, if you see my revenue recognition policy, even last year, we have stated that we have moved to a revenue recognition which is net of expectation of any losses. So this year we have already provided as per the norms agreed with the auditors, and there is no additional provisioning requirement that has come up. So I hope that answers your question.
Yes, thank you. The next question is from the line of Nimish Shah from MK Investment Managers. Please go ahead.
Yes, sir. I just have one question. In the last 4 years, we've added around 1,000 units. So can you tell me how much are the owned from that 1,000?
So I think offhand we do not have this figure. Definitely I remember Naldhera coming in as a part of this 1,000. I definitely remember Munnar we added some units. We had added some units in Coorg. We can definitely get you these figures from our internal archives. Offhand, we will not be able to answer this question. But our overall ratio, as I mentioned, remains at about 65 owned and 35 leased.
Thank you. Ladies and gentlemen, that was our last question. I now hand the conference over to Mr. Kavinder Singh for closing comments. Thank you, and over to you, sir.
Right. I would like to thank my colleagues Iro Rossi, Nina, as well as Akhila for being with us during this Q4 earnings call. And I would like to thank all the analysts, investors who were there on this call. And we are very happy to take questions offline as we normally do. And we hope that we were able to answer the questions to the best of our ability.